The following presentation is presented by Team 1, which is Lillian, Owen, Ronnie, Rose, Sharon, and William.
Okay, this is Ronnie speaking. I'm going to speak on the macro economy. Global economies continue to recover and grow from the economic slowdown that occurred in 2008 and 2009. Emerging markets, no surprise, the developing economies are continuing to lead and are seeing strong growth. Companies such as Brazil, Colombia, Mexico, Russia, some of these emerging economies are growing. Advanced economies are improving, but at a slower pace. GDP growth in emerging markets and developing economies are forecasted to grow 5.3% in 2013 and 5.7% in 2014, which is quite healthy growth. This is in contrast to advanced economies such as U.S. and in Europe, which are growing at a much slower pace. For example, U.S. in 2013 is only growing at 1.9%, and 3% in 2014 is what they forecasted. Europe is forecasted to grow actually negative, less than 1% in 2013, and a very paltry 1.1% in 2014. In the U.S. may not seem very high, but at the same time, there is improvement driven, mainly due to the historically low interest rates, what people are calling easy money, and also at the fact that the housing market is growing as well, is showing some, should mean stronger growth down the line. In Europe, negative forecasts are reflecting weaknesses not only in the peripherally, in Italy and Spain, which are actually contracting their GDP, but also in the core nations such as Germany, which is only expected to experience 1% growth in 2013, and France is also going to have negative growth. Over in Asia, Japan, after years of deflation and little or no growth, is forecasted to grow 1.6% in 2013, which is fueled by government policy such as quantitative easing and fiscal stimulus. China, however, after years of double-digit growth, is slowing down and is expected to grow by 7% in 2013. And from now, I'm going to pass it over to Will.
The market segment in our market contains customers desiring mid-level quality at high-level featured products, and the market tends to like low-cost strategies. Our initial strategy, our management team initial deliberation, led to the conclusion that our company should attempt to capture the high-quality market as well as high-features market. In order to improve our quality and feature amount, we invested heavily in research and development, even purchasing CDs with which to gain interest. We eventually opened a new plant because we assumed more capacity would be necessary for the large amount of projected sales we thought would be reached with our strategy. We successfully reached our market target as the quality and feature leader, but at a great cost to our business. Our company thought it wise to increase our sales force and offer high salaries in hopes of moving our high-quality products with more success. Because we were the leader in these markets, we assumed raising the price to regain all the initial investments would make sense because high-quality products should make more capital per unit. However, regardless of our high-quality and high-feature status, we were consistently losing market share to the rest of the industry. It turned out our sales force not only failed to show a significant increase in sales, but also our higher salaries were costing us more money than we were making on that. We then had to lower salaries, and subsequently we lost several new hires. Our company could not justify lowering unit sales costs to compete with the industry average with the products we currently offered, and the continual loss of revenue led us to believe we could not succeed in our current market, so a new tactic had to be established. Our management team decided to challenge the rest of the industry, which was mostly concentrated in the mid-range quality and mid-range features, by lowering our quality and features, but offering just enough unit sales price to undercut the competition without falling below our cost of goods sold. In year 5, we abandoned all investments by getting rid of our CDs and closing the plant we opened early on. We all had also noticed that regardless of our strategy, Pandow was typically losing us money, and even if it did make a profit, it was not worth the effort to keep it running. We decided to drop operations in Pandow altogether, which allowed us to divert our investments there to our other 3 locations. Since year 5, we have noticed steady improvement in market share and net profit, especially when Pandow was shut down. Since then, our main issue has been accurately forecasting sales, which led to several consecutive quarters' worth of unacceptable levels of ending inventory. By the end of year 6, however, we had honed in with high accuracy an inventory level that our company found satisfactory.
Okay, this is Ronnie again, talking on the key financial metrics. I'm going to focus on 2 key areas, the top line as well as the bottom line. The first slide here, as you can see, is the revenue, COGS, cost of goods sold, and the gross margin trend. As you can see from the blue line, we've seen healthy revenue growth from year 1 through to year 7. Overall revenue from year 1 to year 7 increased 44%, which averages out to about 7.29% year-over-year growth on average, which was positive. Unfortunately, though, our COGS has grown as well, and at a faster clip than revenue. 72% increase from year 1 to year 7 in terms of our COGS, which is again contrasted with the revenue growth of 44%. And if you factor in the average, it works out to be 14.9% year-over-year COGS growth. So not surprisingly, we've seen a decline in our overall net margins, which I'll cover on the next slide. But if you look at our gross margins, they've averaged 52%, very healthy. However, a 13.8% decline from year 1 to year 7, namely not because of the revenue growth, because of our growth in our cost of goods sold. In terms of the bottom line metrics, when we were looking at the gross margin, expense and net margin trend, expenses have averaged about 40.1% per year. Expenses have grown 42.2% from year 1 to year 7, also coinciding with our revenue growth. But when you look at the gross margin decline plus the increased expenses, overall has contributed to a negative profitability. Net profit has actually declined from 12.5%, which we had in year 1, down to actually a negative 2% in year 7. So this next slide is just highlighting some key financial performance metrics, namely sales, net income, market cap, earnings per share, and dividends paid. As you can see from the line at the very bottom, we didn't pay any dividends at all throughout the 7 years. From the perspective, we thought that the money cash flow generated could be better used and invested in our operations. Sales, as I covered previously, 10.5 million year 1, growing to 15.2 million in year 7, healthy. If you look at the net income, years 1 through 3, we had over 1.3 million in income, and all 3 years continue, which was great. Unfortunately, 4, 5, and 5, we had negative income, and 6, we managed a positive return. And year 7, we slipped back into the red, if you will. Our market cap has hovered consistently between 5.5 million and 6.2 million dollar market cap, which puts us as a small cap company. Earnings per share, years 1 through 3, were just over 55 cents to 57 cents, declining to negative 40 cents in year 4, 5, and 6, and then in year 7 we were able to manage just over. Let me back that. That was 5.5 cents in year 1, 5.7 cents in year 2, just over under 6 cents in year 3. Year 4, 5, and 6 were just under a penny a share negative. I'm now going to pass it on to the next person. Thanks.
Hi, Professor. This is Rose. I'll be presenting on the closest competition. Initially, companies 4 and 6 were our competition because they were also targeting the high quality along with high features. But overall, company 5 would be our main competition. Their product position would be mid-quality with high features. and they were premium pricing and price leadership. Some of the activities that they did was they didn't really make changes to their product qualities or features until the end of year 4. They changed in M3 and Pandal. They increased the features and the qualities, and pretty much kept it consistent subsequent years. In year 5, they closed Pandal after our company closed in year 4. Annually, they would increase price by about $1. By each quarter, they increased prices by 15 to 35 cents. In year 7, they drastically increased prices to $14.50, and it pretty much they pretty much became in the red. And to recover from that, they tried to lower prices to $9.73, but they failed to do so. But by the end of year 7, they increased the price back to $12.65. I will be now passing along to Ronnie.
All right. This is not Ronnie. This is William here. As I discussed before, our initial strategy here, I'm just going to recap it again. All right, Professor William here again. Here's to recap our new business strategy for years 5 through 7. We decided to get away from the high-quality, high-feature market and meet up with the industry average at about the mid-range quality and features. We wanted to challenge the norm and try to beat out our competitors' prices by just enough to where we don't lose money, but we also gain market share from them. We have abandoned our CDs and therefore all the interest that we accrued from that. We also closed our plant we foolishly opened in the beginning of our operations and decided to cease operations in Pandao when we decided that investment there could be better used elsewhere. Additionally, after we implemented all these, we noticed steady improvements in market share and net profits, except for a fluky 7th year that didn't go our way. But by end of year 6, we had our sales forecast fairly accurate, and we honed in on the satisfactory ending inventory. So we consider our operations to be satisfactory.
This is Sharon. In the early years of our company, it was important to invest in R&D because we wanted to have good quality products with great features at an affordable price. We tried to roll out with new product lines and stay ahead of the market industry with our products. R&D was monitored and adjustments were made each quarter to determine whether we needed to increase or decrease the amount being spent in relation to our product line. As R&D was increased, new models were introduced to each region with different levels of qualities and features. Regarding employee training, along with investing in R&D, it was also important to train our employees so that our production lines were working effectively and efficiently and producing at an optimal level as well. As R&D was raised, so was the amount spent on employee training. The sales force was closely monitored to determine if transfers or layoffs were needed. Making a decision to lay off salespeople resulted in a loss of the bottom line. It was decided that as long as we had enough people in each region and sales were being met, that the amount spent on employee training was not increased.
Hi, Professor. This is Owen. I'm going to be talking about the positional analysis. From years 1 through 4, we aimed at a high-quality, high-featured positioning for all geographic locations. That includes Pandao. We had the high quality and the high feature product that we had selling back then. And then at year 5, we made a lot of changes. We saw a decline in profits. That's why we found out that we needed to make some changes. So we switched to a medium quality and medium features product for all locations, including our international location. And This change actually helped us increase units and increasing profitability. By years 5 and 7, we decided to continue using the medium product on our 4th model, I believe, and then that's what we ended up finishing up our simulation with. In the marketing analysis, in the first 3 years, we kept our advertising budgets for all geographical locations between $6,000 to $80,000 per quarter. We felt like this number was, a good static number to start with to, get the touch and feel of how much marketing we should put in. By years 4 and 5, we felt like that wasn't enough, so we decided to increase our sales to increase brand recognition, audience, and for our new tier model, which is the high quality, high featured model. So we decided to increase our advertising to around $100,000 per year for each quarter in each location. In order for us to continue on this, when we lowered it to our mid-tier product for years 6 and 7, we actually increased our advertising budget even more to $120,000 to $140,000 for Americas 1, 2, and 3. Due to closing Pandow, we allocated our advertising money into our Americas 1, 2, and 3. And we felt like that's what worked, and that's what helped us create more profit. And Okay, we're going to be talking about production planning. For our production lines, we have a full production lines that will constantly be running each quarter. We're going to use those at the maximum level that we could. All lines are used when we are permitted, so we have 8 lines available for each of our plants, and we use all 8 lines. The hours are maximized without going into overtime, so we didn't want to pay the workers more than they need to, so they worked 40 hours a week with 8 lines running. Our sales order strategy were entered depending on the way inventory were ending, and ending inventory was the basis of production planning in each quarter. So that means we allocated however many units we needed depending on the previous quarter's ending inventory. Through sales staffing, throughout the duration of the whole simulation, we try to keep around 12 to 15 salespeople in each geographical location. We felt like this was the optimal level of sales before, through the equilibrium point decrease. When we closed Pandow, we allocated those salespeople in Pandow into Americas 1, 2, and 3, so that it still equals out to about 15 salespeople per area. To promote the sales of these salespeople, their salaries were put at $2,500 and $87.94 for Pandow. This salary was really pretty minimal compared to the industry average of other companies, but we felt like this was needed to increase sales because our commissions, we actually paid them a lot higher at $30 an order to encourage them to continue selling units. Back to our bonds and financing. We sold bonds every quarter to create money that we needed. We purchased about $10 million worth of bonds that would be repaid later. We felt like this money really helped us build our new plan and all the other advertising budgets that we needed later on. The bonds helped us raise significantly, allowing the ability to operate without losing money at the end. Our stocks were issued. We actually sold to the shareholders in year 3. It provided insignificant company success, so stocks are no longer sold for the rest of company 1's well-being. Continuing on financing, Pandow currency exchange proved to be unbeneficial. Our currency was too high to bring profit, increase income. Financially made the decision to close Pandow, whole income raised after Pandow closed, collectively proving that a high currency exchange rate deemed unsuccessful. As for our investments, we did not have any forward investments. Focused financially on growing Company 1 as a whole and making profit. What we learned overall was we had to analyze inflation and deflation before making decisions in a foreign market. We weren't aware of Pandow's up and growing inflation that they had when we started. It was at 6-to-1 ratio, and by the time we ended, it was around 9 to 10. Our prices didn't, follow the inflation market, so that's why we continued to lose money when that happened. Second point is when advertising increase, sales will increase, but we need to make sure we have enough salespeople to handle that demand. If our demand is high, but we don't have enough salespeople to fill those orders, it doesn't matter how many that we, how much advertising that we put into it. We didn't put that into consideration, but we know that for next time. We need to analyze the characteristics of each geographical market in detail. Each location will react differently to changes in the pricing, advertising, and etc. Each America and each geographical location would act differently to each price change. So price changes shouldn't be universal through all three or all four geographical locations. Some would like quality more, some would like features more. So we gotta set our prices accordingly. We shouldn't build a new plant until production that we're about to reach optimal output. We ended up building a plant by the first quarter that we started. That actually was not beneficial to us because we ended up losing money just paying off the plant. And at the end, we had to close down the plant because we didn't even use the output that was available for us. So next time we should actually plan out when a new plant should be built so then we can actually optimize the plant. If we were to start over, we wouldn't build a plant until we were close to hitting maximal output on the original plant. So that would actually make our investment more beneficial. Okay, Professor, that would conclude our presentation. Thank you so much for watching our presentation. I hope we get a good grade. Thank you so much.
Thank you, Professor.